Today, we are seeing some of the best opportunities to own and invest in self-storage that we've seen since 2015. In this video, I'm going to walk you through step by step everything you need to know and understand from finding to buying, owning, and operating a self-storage facility. Self-storage offers one of the best opportunities to own a cash-flowing commercial real estate asset. But unlike most commercial real estate, which we think of huge buildings, multi-millions, tens to hundreds of millions, self-storage offers opportunities in the hundreds of thousands, making it comparable in many markets to single-family or duplexes, except there's no toilets, running water, and you don't have people living in them. At least you're not supposed to. That's actually against the law. Make sure that doesn't happen. The simplicity of the asset and the necessity of it makes it one of the best investing opportunities. But it is different than a lot of different real estate assets that we're familiar with. So how do you go about it? How do you take advantage of this opportunity? And how do you operate the thing? We're gonna walk you through everything. And we're gonna break down each part into sections for you so you can understand the process along the way. In each section, I'm going to give you the goal of the section or that part in the phase of finding, buying, and operating a storage facility, the checklist, and the tools that you need. This is going to be comprehensive, so be ready. So let's get started by looking at the market or the market selection. Where should you buy and what makes a good market? First in this breakdown, the goal. The goal here is that you know what you're looking for and where you want to buy before you look at a deal. I often say we don't find good deals, we make them. And that is very true in self-storage. So the first thing you need to know about market selection is storage is dominated by supply and demand. I always say that the best operator in the world will fail in a market that has too much supply or little demand. And the newest or even the dumbest investor will succeed in a market that has high demand and little supply. So for your checklist, what you need and what you need to look for. The first thing is population. Is it shrinking? Meaning, are you losing customers? That means every single year that goes by, the overall demand for that product is getting less and less. But it is important to remember that in storage, we actually have two markets that you need to analyze. One is the market or the demographics, the people, the location itself. The other is the market of self-storage. One equals demand and the other equals supply. And these things can offset each other, meaning you can have a high growth market that actually has very little demand. Why? Because you have so much supply. And you can have a low growth or a market that's not even growing at all that has high demand because there is so little supply and none coming. Either way, those two things will equal either no demand or high demand. So we look at the two together. To understand that market of demand, we want to look at the population growth. I actually don't care if the market is booming or growing fast. The biggest thing is I do not want to see a market that is declining every single year. It's literally shrinking and going away. Because even if there's not a lot of storage, and so that makes high demand for storage at the time, that will catch up eventually. And that's a dangerous situation. It also hurts you on your opportunity to refinance or sell if there's no one in the market that wants to buy because the population keeps getting less. But for markets that do not have growth, lots of times they're very stable. These are small markets that are stable, haven't changed, or they grow a little, that are under supply and demand is really, really high. Some of the things to understand is employment and the housing market. Demand for storage comes from two things. First and foremost, movement. If people are moving, they need storage. The next thing is necessity. You see, what actually makes storage demand is not just that we are hoarders, which is also true, but it is that over time, regulation to property and your home has gotten so high it limits and restricts what we can even do with our property or on our property. The next thing is the cost of housing and real estate has gotten so high. That means it is more affordable to rent space than add on to your home. And in lots of cases, you can't park a car or an RV, and you can't add a shop onto your home, even if it was affordable, due to the restrictions. When we look at the self-storage side, we're looking at the overall supply. Now, this can be a little more tricky. The key to understanding demand, and if there's demand in the market, we look at two things: rents and occupancy. Meaning, is there stable occupancy and do rents go up? It's the combination of the two. Let's say you're in a market that has high occupancy, but if someone raises rents, occupancy immediately drops. That means you've hit a sensitivity in that pricing where people just won't pay for that price. So if price goes up, it's not even that they have options for other storage units that are cheaper, they just won't rent. Now, over the last 3 years, storage has been hit hard due to the freezing in the housing market. And that has actually developed the incredible opportunities that we're seeing to buy in this amazing asset class. But a lot of markets you've seen rents go down as demand generally went down, and so we have rents drop. These rents dropping are very important to understand the context of the situation. Look long term and look at the occupancy. At the end of the day, stable rents, no new supply, or low supply equals high demand. The next side of it is the future. So both future population, but the future of storage. This is how you know that. Are there any storage facilities that are currently being built? Or are there plans to build storage facilities? How do you know that? You go directly to the source. You go to the city or the county and you ask them, please provide me with any storage facilities that are currently approved or being built. And then you ask for land that is available or approved for storage. That way you understand what the future supply might look like. Key things to take away from this is a new storage facility is coming into town, or within that 3 to 5 mile radius that you're in, you should be very concerned about what that new supply will do to the market. The smaller a market is, the more impact a new storage facility has. What the total impact will be dependent on the population. Generally speaking, if you're starting out, I would just be wary and avoid areas that have new large facilities coming in within your 3 mile radius. Now, here are your tools to understand this. First and foremost, Tract IQ. This tells you everything about current rents, the storage facilities and competition in your area, to the demographics, and it plots it all out. They are the top provider of this data that focuses just on storage. We use them at our firm, and we suggest that other people use them. Next, you can look at Redfin, the overall census data and local permitting data that you can go directly to the sites or go walk into the office of the city or county and ask them. The most important thing when looking at a market is to understand the kind of market you want to be in. Do you want to be in a big, fast-growing market where assets cost a lot of money, but there may be a lot of demand and competition is really high? Or are you looking for an entry facility that's maybe $500,000, not a lot of competition or not good competition, something like value add? That will dictate the market and the location that you're in. There's a big difference in going into a small city that has 15,000 people versus Austin, Texas. So understanding your strategy and what you want to buy, the price level, and the type of competition will dictate that market. Look at a map where you live. Look at a large radius around it and identify the type of market that you want to be in. A simple way, either stabilized growth or at least not shrinking. Size of the market. I want to be in a big city or a medium city or a small city. And the type of asset. I want climate controlled or just drive up gravel. All those things will determine how you select a market. All right, section 2, deal sourcing and underwriting. Now, when we look at deal sourcing and underwriting, there's a few things. The goal here is to identify and evaluate viable facilities. Now, when we talk about the type of facility that you want to buy and the market, these are two things that I include in what we call our buy box, knowing what you want to buy and where you want it to be. So for a lot of people that are starting, just like I started out, it was small facilities in small assets. We were buying facilities at around $300,000 in more rural markets that were stable or had some kind of growth in the population. We wanted simple drive-up facilities that were in good locations but not well ran. That then led us to identify the markets and then all the facilities in those markets. A really important piece of this in your buy box is to give to brokers or tell other people when you're networking. Why? Because if you just ask them to send you a good deal, that doesn't mean anything. They don't know what a good deal is to you because a good deal is different for everyone. So I would go and say, I want a small facility. I'm talking 30,000 net rentable square feet, and I want it to be in a city that has 15 to 50,000 people in that city located in these 3 states. The facility type or quality, drive up, I want it to be mom and pop and poorly ran. The reason being is I want to buy it and be able to improve it. That now gives a target for you, but also the brokers or the networks that you're creating. That way those deals can come to you. When it comes to underwriting, we don't just use whatever the broker says. We buy on pro forma, but don't pay for it. That's important, and I'm going to restate this so you understand. Pro forma simply means what it could be. So if I buy it, what will it return? I buy something that I believe has good upside, or I can improve it, or will be stable. That is on pro forma, our projections. But I don't pay for pro forma or projections. I pay for what it's doing now. How do you do that? You do that in your underwriting. Now, there's a lot of things that can make underwriting complicated or a lot of unknowns. That's why we use and suggest for tools to use Cactus. Cactus is an underwriting engine that works on your NOI, your cash on cash, and sensitivity analysis. It is very simple, easy for you to use, and walks through and is specially made for storage. So for beginners or even professionals, it streamlines it. It tells you what you need, and you can go get that from the broker or the owner to input to your underwriting. Very step-by-step hands-on. You're going to need rent roll, your financial historicals, as in currently and past. You're going to want a P&L, a profit and loss for the last 24 to 36 months. You're going to want comparable market rents. Now, those things we can find. Cactus helps us with our underwriting, but then we use the same thing we looked at our market selection when we worked with Tract IQ. They actually poll market rents. Then you can input that into Cactus. We're making this as easy as possible for you. You're going to want all of the expenses associated, including taxes. Now remember, taxes aren't what they were paying, but taxes are whatever it will be at the price that you buy it. Meaning they built it for $100,000 20 years ago. You're paying $500,000 for it today. The taxes that they're paying will not be the same as what you will pay on the new purchase price. That is going to be dependent on county and state. Go directly to the county and go understand how they adjust the taxes. That's the number that you put in your underwriting that you're going to use in your Cactus software. Now, I don't want you to be overwhelmed. I know you're going, this is great, but how am I going to remember all of this? And we're just getting started. So what we're going to do is get you the checklist and the information that we go over here. So you can watch, hear it explained, but then you'll also have your checklist. This is totally free education. All right, let's keep going. Section 3. This is your financing and your capital stack, as we call it. The goal here is that you leverage safely. In self-storage, we usually put a lot down, meaning banks require 30 to 40%. Now, you don't always have to do that. There's ways that you can put less down through an SBA loan. That's a small business loan. So your options here are a few. First of all, you have conventional commercial loans. Now, where do you go to get those? local banks and credit unions, by far the best. Don't go to the big national ones. The local banks and credit unions, they deploy capital locally, they understand those markets, and this is a normal, customary thing for them to do. Now, the next option is SBA loans or small business loans. These 504 loans you have to be careful with. Why? Because first and foremost, the person that you're working with, all they do is put together an application and send it, and then it has to be approved by the government. That's why we have one partner, which we suggest, that works nationwide, because unlike a conventional, this is an SBA loan. They specialize in storage, but more importantly, they are the approver, meaning they do the underwriting and approval. So if they tell you that you can get approved, you can actually get approved, because they're the ones that stamp it and give the government approval for it. They are the #1 SBA lender in the country. And by using a small business loan, you can put down as little as 10%. That's Live Oak Bank, who we use to do SBA loans. You also have bridge or construction loans if you're building, but we're not going to focus on building right now. Bridge loans are very different. They're short-term loans to get you into permanent loans. Now, those can come from private lenders or conventional lenders, depending. And the last option is a syndication option, which is you go out and get private funds, friends and families to give you the money to buy it. Now, for the down payment, that can be self-funded, or you can actually go get, like syndications or privately, the money to put down. So you still get a regular loan, but you get friends and family to come in to buy it with you. All right, for our checklist here, remember, we're talking 30 to 40% down unless you go the SBA route. You need to have fixed debt, and we like to have long-term fixed interest rates, not floating rates, so that way you can actually plan. At today's high interest rates, though, we try to get no prepayment penalties, meaning if interest rates go down, I want to be able to refinance it into a lower rate. So be careful about that. You want to hold 6 to 12 months of reserves, and that's important when you're doing the overall purchasing and financing. So you make sure you have a runway to pay expenses, bills, and also cover the financing. Revenue is moving. It doesn't work like an ATM or a bond that just gives you money, right? This is an actual business. That means some months you make more than other months. You need to be prepared for that. And since you haven't already owned it, when you buy it, there's lots of things that you're going to learn. Make sure you have a reserve account. I like to have about 12 months. That way, as we're learning, we have a cushion for the down months and the up months. This helps us build out. What we don't use, you can always distribute or take back. The next thing on your list that you got to make sure that you have is a cost segregation ready. See, this is the depreciation part and one of the main reasons why people invest in real estate. And a cost segregation lets you depreciate a huge amount of it. We're talking like 50% year one. That really gives you a good return when you get a giant tax write-off that year one. So you need to have a cost segregation expert working with you that does self-storage. And of course, on this checklist, you need to have an attorney that specializes in commercial real estate to review all the docs that you are signing with the banks to work with you. We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others, because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it going to look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank, it's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. Now, let's move to the acquisition and closing. The goal here is to protect yourself at that finish line when you actually go to buy. I find a lot of people, they find the markets, they find the assets, but then when they go to put it under contract or they go to buy it, it's like they caught a tiger by the tail. And then they're worried because they're like, I don't know what to do. So the first thing you want to do is when you are going to put this under contract, you start out with an LOI, a letter of intent. That is a simple, non-binding outline of what the PSA or the actual purchase and sale agreement will say. It just hits the main stuff. What is the price? What are the expectations? Do we have 4 months to close? When does money go hard? You give the LOI to an attorney and they make the actual PSA. That way, though, you're not wasting time spending money on attorneys with the seller where you don't even agree or can't agree on the main things, on the things that make or break the deal. A simple LOI, you both sign it, it's non-binding, give that to the attorneys, they make that purchase and sale agreement. Then you sign that. This actually leads you to the closing. This dictates the terms, the time, and everything else. In that PSA, you are going to want a lot of things like due diligence and due diligence that you need from them. The due diligence time that you set in place, make sure it doesn't start until you receive everything you need from the seller. So you can't do your due diligence until you receive it. So don't start the due diligence date, and let's say it's 2 months, and then you're arguing with the seller for a month to try to get information. Then by the time you get it all, your due diligence period's almost done, and now you're in a tough spot. Instead, in the contract, just say, due diligence starts once we've received our due diligence list that we give you from you. Then we can do due diligence. So your checklist here, you're going to need title and a clean survey. You're going to want your overall LLC formed and an operating agreement done. You need to have insurance coverage like property and liability, including tenant. Make sure you are working with an agent to get that all done. You need bank accounts set up and you need bookkeeping set up. Management contracts are all done, including release agreements with the tenants ready to go. You need a list of all third-party vendors and you need to alert them and have them all ready for transfer day. This includes things like your software, that is your property management software. That is what runs the facility and tells you everything that's going on. You want, day one, utilities to move over, third-party vendors to all have their contracts done. If there's an employee, you need to have that contract all lined up so the day that you close, everything's transferred over to you. This leads us to section 5. I know, I told you, this isn't a lot of fluff here. This is the real stuff. I'm giving you the exact steps, and it's in detail. It's not meant to overwhelm, but make you feel more comfortable about going down this process so you know everything that's included. Not just simply talk and hype, but actual something that you can execute on. Step 5, set up for operations. The goal here is ready to open. The things that you're going to need when you get ready to open. First of all, you have your tech or the background. Then you also have the administrative side, the physical asset side. So let's walk through. There's a few things that you need. First of all, we utilize Tenant Inc., which is a software system. It's a property management software system, and that does everything associated with the property. It allows people to rent online. It manages bills, automatic payments. It shows you what units are actually rented and which ones aren't. It gives you everything you need to know about your facility, revenue, planning, all of it. The next thing you need is something like revenue management. Now, this is especially important when you're dealing with larger facilities. Revenue management allows you to understand what price should I be charging for which units and what time period. And if a unit becomes open, what should I price it at? And the units that are rented, what rate increase should I give? We utilize Now Metrics. Now Metrics is actually a software that we developed, and it is our personalized revenue management system that we've been using for 20 years. The next thing you need is a call center or somebody to take all the calls and administrative during closing hours, especially if you don't have a person on site all the time. This is really important. When they call, who are they going to call? Are they going to call you, or are they going to call somebody else? And if they're going to call a call center after hours, can that call center rent, take care of billing, or any issues that they have? The whole customer service part. This part can be difficult for people to wrap their heads around operations because it's so different. What we did is we made it easy. We just put together what we call a storage operating system that can be handed off to people. That includes marketing, web, SEO, brand, all that kind of stuff. So you can just take it, adopt it, and put it on your facility. So check out Self-Storage Income. There's options like that for those that are like, I don't want to self-manage, but I also don't want to pay a high-paying third-party management company. I just want all the tools and everything that I can use to do it. The other option is, I don't want to do it at all. I just want a third-party management company to do it. They generally charge around 5 to 6% flat of gross revenue. But they also charge lots of fees and other things that can result in 10 to 15% of gross revenue. So third-party management can be very expensive, but that is just the total hands-off. I don't want to do anything. I want somebody to take care of everything. Your administrative setup is an EIN, your actual business license. You need the merchant processor, right? This is credit cards, ACH, all of that. Now, a lot of that comes and can be built in with your software, like Tenant, your property management systems. But you also need the bank accounts that can attach to that. That's got to be set up. You need your tenant insurance program. We utilize a tenant insurance program that actually pays back a huge portion of the premium. So it's a line of revenue. We're talking 75 to 80% of the tenant insurance premium we get paid back. That is a huge revenue line that bolsters that net income. You need to be on Google, have Google listings, be on the map, and you need a website that is live, interactive, can take rentals, and then you need SEO. You need people to know who you are, where you are, and how to get a hold of you. This leads us to section 6, agreements and legal setup. All right, you've got to protect yourself. You got to protect your operations, your business, your money, and you personally. Now, every state is different. You can work with the large associations like SSA and others that actually just provide you state compliant lease agreements, storage specific for your location. You need to make sure you have in language with your tenants all late fees, lien language that are all compliance within state laws. You need to have auto pay set up, and you need to have enabled through your PMS system, that property management software system. You need to have e-signs, making it available to rent and sign documents online. You need to have tenant disclosures, move in, move out procedures, and you need to have them documented. Normal business stuff. Remember, storage is simple. It's a box, and people rent the box, but you have to do it right. And if you have the right system, it's fluid and a simple process. And most of what we're saying is done by third parties, but you need to know what to ask, and then they administer it. You also need to have digital record storage. Communications and contracts. Where are you storing the contracts so they can be pulled back from any time? Your tools, the state associations, obviously state and self-storage specific attorneys, as well as things like store local. It's important to understand that storage is specific. Now, if you want that stuff ready, made, and operations in a box, this is where things like Self-Storage Income comes in. We give out our information for free, and we also discount these services if anybody wants them. This leads us to number 7, section 7, the on-the-ground management part. Most of what we've been talking about is legal setup. We're talking about the online side, making sure that it's all ready to go. 80+% of people find you from mobile. So online is not just important, it's necessary. But there is no such thing as a manless storage facility. It doesn't exist. This is not a website. You are still in real estate. You have tenants. Someone needs to take care of the grounds. When someone moves out, someone needs to clean out the unit and prepare it to get it ready for a rental. Someone will have to go to the site to do work. The goal here is daily ran, consistent operations that are efficient. Let's talk about tasks. You have open and closed inspections. We're talking lighting, doors, locks. Does what the property management software is saying is rented, does that match up with locks? Or is someone in a unit that is not paying or not rented? So lock inspections, as we call it. You need to make sure that the site is clean and it looks good, is well lit, and can be seen for marketing and advertising. You have tenant calls and customer service, very important. We want to automate as much of that as possible through online communications and call centers. Now, storage facilities may not be manless, but you need to whittle down as much work that needs to be done on site as possible. We call this automation. We want our operations to be automated through the use of our property management system, our revenue management system, and our marketing. Move-ins, move-outs. You need to verify ID, gate access, and contract signed. Once again, these are things that are done through Hummingbird or Tenant Inc., the product, your property management software system, or other property management software systems that do the same thing. You have overlocks and delinquency checks, meaning if somebody doesn't pay, they need to be locked out. We overlock their unit until they pay, they don't get access. If you have a gate, also shuts down their gate control. If they're not paying, a paying tenant, they can't get in. You can also automate this through the software. If you have a gate, the overlock has to be done manually unless you have keyless technology, which just basically means the lock is a digital lock that they're using from their phone, which we use. Having a hardware matched with your software on site, that really makes it easy to automate and streamline. You have daily reconciliations of payments. You have clean and rented vacant units, which we talked about. And you need to be recording incidents or security issues. Now, this turns into either remote or on-site staffing. I view it as fractional staffing. So even though we have an automated system, we have fractional staffing. Someone that's hired out to clean out a unit, get it ready for resale, and check the property. We have contracted out with maintenance and landscaping, that they come on site and are making sure everything's okay. That way, once again, most of the stuff is automated. Incident reports can go to someone where they can go on site. This allows you to remote manage. We have facilities in over 10 states that we operate efficiently through these things. Large sites have things like full-time managers, which they have an office, and they're there ready to sell products, move people in, deal with issues during office hours. Not office hours, you need, once again, the call center or the service center to help you. This leads us to section 8. How do you get tenants? The first thing is marketing and your tenant acquisition process. The goal is to keep occupancy high and rates high. Channels that we use SEO and Google ads. We also use Facebook plus local ads. You can do all sorts of things with like partnerships and great signage and lighting for the facility for drive-bys. Review generation is a massive one. You need reviews on Yelp and Google. This helps lift up your site to be front and center when people are looking for storage. The metrics that we use to analyze how we're doing are things like cost per lead. We look at lead rental conversion, average customer length stay, or what we call LTV, long-term value. How much are they paying in rent? How long are they staying? What is the total value of that customer in the lifespan of them being a tenant for us? And review ratings and bolstering. Our automation setup we have via SEO management, website, online rentals, leads, and then we include hardware like gate and maybe lock systems, but then we use our offsite partial management that comes to the site and checks things out. Now we move on to number 9. I told you guys, this is in depth. So please, if this is helping you guys, like and comment. This is the playbook and it's in depth, and that's how you can help me. Number 9 is the financial management part. Know your numbers and reporting. Systems. We have our Now Metric systems. We have QuickBooks, we have Tenant or your property management software system, Hummingbird or whichever one you're using. Then you have your monthly P&Ls to review, your NOI tracking versus pro forma, how it's going versus the plan, your CapEx tracking. So what are we spending? Did something get broken? Do we need money? Do we have reserves? You want to look at your tax preparation and cost segregation. This is all part of the financial system that you're looking to improve NOI through bolstering revenue, keeping expenses low while maintaining a quality product so you can achieve that. Checklist, reconcile monthly accounts, compare revenue versus market, meaning look at your rates compared to market rates and your in-place rates versus what the market rates are. You want to run delinquency and collection reports. Who's not paying and how many of them have you collected? This could be a huge problem. And you need to make sure that you're updating your insurance and your tax rolls annually. Don't want any surprises there. Now, this finally leads us to number 10. Number 9, we talked about that revenue management, net income, getting that cash in the account, making that cash flow. Number 10, we're talking about exit or scale up. When we talk about exit, we don't even necessarily mean selling the property. But as that revenue, that NOI increases, and as your property becomes worth more, you have equity. How do you access that value? The goal here is to turn one site into a portfolio or more assets. You want to compound out your returns. You can take that refinance, or you can take that sale, 1031 exchange, and buy another property or buy more properties. This allows you to magnify then your assets and your returns that you're making, or refinance it and deploy it into other assets, therefore diversifying your portfolio, harvesting wealth while still keeping that cash flowing asset. Remember, storage isn't about units, it's about systems. Self-storage is a business more than it is real estate, and you got to treat it like it. Although it is simple in concept and understanding and what we do, it can be more complex in the system. You can get rid of complexity through systems and help. That is why self-storage income exists, to allow people to get into the self-storage industry and apply known systems with third parties that are vetted and working, so that you can buy into this incredible asset class that has high cash flow, diversified in lots of doors, low maintenance, and builds value over time for you, your family, and others. Once you build out your systems, your checklist, your softwares, your third-party support, now you can go do it again and again and again. And this is what we did to accrue over $450 million in assets under management, all starting from one little facility worth a couple $100,000 in a rural market. That is the thing that I love most about storage, is how easy it is to scale. You can scale horizontally and vertically, meaning I can add more properties, but I can also add the size of the properties. We accumulated 6 small properties, we sold them, refinanced one of them, and then we added 10 more. But the size of the other 10 were over double the size of the individual previous 6, vastly expanding our overall portfolio. And then as we grew, we added more properties, but we also added in size and markets. Some facilities being in first tier, multi-story, 200,000 net rentable square feet assets, all from a small drive-up gravel facility that had no gates, no real technology, no nothing, to now fully automated multi-story first-tier market facilities that are worth tens of millions. This is the playbook. This is why I wrote the 2 best-selling books in our entire industry, Growing Wealth in Self-Storage, which are full. One's basically a textbook, a 400-page book of exactly what to do. Make sure you like, follow, comment below. We'll send you the checklist, and check out Self-Storage Income for more information on your self-storage journey. Thanks, everyone.